Break even sounds responsible. Break even feels intelligent. Break even looks like discipline. And that is exactly why it has ruined more traders than reckless risk ever did. Break even is not protection. Break even is hesitation disguised as safety. Most traders were introduced to break even early in their journey. They were told, once price moves in your favor, move your stop to entry. That way you can't lose. It sounded logical. It sounded professional. It sounded like risk management. What they were never told is what break even actually does to behavior, structure, and expectancy. Break even does not protect capital. It protects fear, and fear does not belong in execution. The market is not designed to reward comfort. It is designed to punish indecision. And break even is indecision locked into a rule. Here is the reality most traders refuse to confront. The market breathes, price expands, price contracts, liquidity is drawn, then redistributed. Structure is not clean. It is violent, engineered, and deceptive. Break even assumes the market should move cleanly once you are right. That assumption is false. The market does not care that you entered correctly. It does not care that you timed liquidity well. It does not care that you read displacement properly. It cares about one thing only: where orders are resting, and break even places your order exactly where the market loves to hunt. At the most obvious level, at the most emotional level, at the level where weak traders reveal themselves, entry price. The moment you move your stop to break even, you are no longer trading structure. You are trading fear of loss. You are saying, I am no longer willing to accept uncertainty. But uncertainty is the cost of participation. You cannot demand certainty from a probabilistic environment and expect to be paid. Now listen carefully, because this is where most traders misunderstand the damage. Break even does not hurt you immediately. It hurts you over time. It creates a pattern of false survival. You stay alive, but you do not grow. You avoid losses, but you also avoid winners. You feel busy, but the account does not move. This is the unprofitability trap. You tell yourself you are being disciplined. You tell yourself you are protecting capital. Meanwhile, your best trades are being cut short before they're allowed to express their full potential. The market offers asymmetric opportunity. Break even destroys asymmetry. Let's talk about structure. When you enter a trade, you are entering inside a narrative. Liquidity has been drawn. Range expansion is unfolding. The market has not completed its objective yet, but break-even traders behave as if entry means the job is done. It is not. Entry is the beginning of exposure, not the end of risk. When price moves a little in your favor and you rush to remove risk, you are misunderstanding market intent. Small, favorable movement does not mean the market agrees with you. It means liquidity is still being engineered. Retracements are not failures. They are requirements. Markets retrace to rebalance inefficiencies, to fill orders, to test participation. That retracement often revisits entry zones. And when you place your stop at break even, you place it directly in the path of that process. So what happens? You get stopped out, price continues, your analysis was right, your execution was weak, and that pattern repeats. After enough repetitions, something worse happens. You stop trusting your model. You say it always comes back for my stop. No, it comes back for your fear. The market is not targeting your entry. It is exploiting your impatience. Now let's address the psychological damage, because this is where the trap tightens. Break even trains you to fear being wrong more than you desire being right. You stop holding trades. You stop letting winners develop. You become hyperreactive. Every tick against you feels threatening. Every pause feels dangerous. You manage trades emotionally instead of structurally. This is not risk management. This is anxiety management. Professional traders do not manage anxiety. They manage exposure. Exposure is planned. Exposure is accepted. Exposure is paid for upfront with a defined stop. Break even removes acceptance. You are no longer at peace with the trade once you move the stop. You start watching price. You start hoping it does not come back. You start negotiating with the chart. Negotiation is weakness. Now here is the part most traders do not want to hear. Break even is an ego tool. It allows traders to say, I didn't lose. It allows them to protect self-image. It allows them to avoid accountability. But trading is not about avoiding losses. It is about managing them properly. A well-placed stop that gets hit is honorable. A break-even stop that cuts a valid trade is sabotage. One builds data, the other builds frustration, and frustration leads to revenge behavior, overmanagement, and eventually overtrading. This is how the break-even trap connects to every other destructive habit. You get stopped at entry, you feel robbed, you re-enter late, you reduce size, you take partials too early, you exit winners prematurely, all because you wanted to feel safe. Safety does not exist in trading. Only control does. And control comes from structure, not comfort. Now let's talk numbers. Break-even traders often boast high win rates. They love to say, I don't lose much, but they never talk about growth because there is none. Small wins, many scratches, occasional full losses. The equity curve moves sideways. Months pass, effort increases, results stay flat. This is silent failure. Losing traders know they are losing. Break-even traders think they are improving. That makes the trap far more dangerous. The market does not pay for accuracy. It pays for holding power. If you cannot hold a trade through normal retracement, you do not deserve the expansion. This is where the mindset must change. You are not paid for entering correctly. You are paid for staying correctly. And staying requires tolerance. Tolerance for drawdown within structure. Tolerance for noise. Tolerance for discomfort. Break-even eliminates tolerance. It turns every trade into a sprint instead of a campaign. And markets reward campaigns. So understand this clearly. The break-even rule you were taught was not designed to make you profitable. It was designed to make you feel responsible while staying mediocre. It keeps you participating without progressing, and that is the worst place to be. Now that the illusion is exposed, we move to the damage that actually matters: expectancy. Most traders do not even understand expectancy, yet they sabotage it daily with break-even management. They think expectancy is about win rate. That belief alone keeps them trapped. Expectancy is not how often you win. Expectancy is how much you are allowed to win when you are right. Break-even management strangles that allowance. Let's get something clear immediately. Institutions do not manage trades to avoid losses. They manage trades to extract range expansion. Losses are already priced into their models. They do not panic at retracements. They expect them. Retail traders, on the other hand, behave as if every retracement is a threat. And the moment price moves slightly in their favor, they rush to neutralize risk. That reaction is emotional, not professional. Here is the mathematical reality. Every trading model is built on asymmetry. You risk 1 unit to make 2, 3, sometimes 5 units. That asymmetry only works if winners are allowed to reach their destination. Break even interferes with that journey. When you move your stop to entry prematurely, you increase the probability of scratches while reducing the probability of full winners. Over time, this shifts the distribution of outcomes. More break-evens, fewer expansions, lower average R. Eventually, expectancy collapses. And here is the part traders hate admitting. Break-even turns a profitable system into a break-even system. Not immediately. Gradually, it is slow enough that most traders blame the market instead of their management. They say volatility changed. They say the market is manipulated. They say their edge stopped working. None of that is true. Their management removed the edge. Now understand how the market actually moves. Markets do not move from entry to target in straight lines. They expand, retrace, consolidate, and expand again. That is how liquidity is distributed. If your stop is sitting at entry, you are positioned exactly where liquidity is needed to fuel the next move. You are not unlucky. You are useful. The market uses your order to continue, and then it leaves without you. This is not theory. This is structure. Now let's talk about win rate deception. Break-even traders often show impressive statistics. High accuracy, few red trades, long streaks without losses. But the equity curve tells the truth. Flat, choppy, uninspiring. Why? Because wins are capped and losses still exist. You take partial profits early. You scratch trades that would have expanded. You still take full losses occasionally. This creates an upside down risk profile. Institutions accept losses and hunt expansions. Retail traders avoid losses and suffocate expansions. That is why capital flows upward. Now, here is where the trap tightens psychologically. Break even creates a false sense of control. You feel like you are managing risk actively. You feel engaged. You feel professional. But what you are actually doing is interfering with probability. Probability needs space. Break even removes space. Every time you move a stop without structural justification, you are injecting discretion into a probabilistic system. Discretion is dangerous when it is driven by fear. Professional discretion is rule-based and contextual. Retail discretion is emotional and reactive. Now let's address timing. Most traders move to break even too early. They do it after minimal displacement, after a few candles, after a small reaction. That timing guarantees failure. Early in a trade, the market is still undecided, orders are still being filled, liquidity is still being tested. That is the worst moment to remove risk. Yet that is when most traders do it. Why? Because uncertainty is uncomfortable, and break even feels like relief. Relief trading never compounds. Now, understand this clearly. If your trade idea is valid, your stop placement already accounted for noise. If it did not, your stop was wrong to begin with. Break even is not fixing bad stops. It is covering up poor planning. Instead of learning how to place stops properly, traders rely on break even as a safety net. That prevents growth. You never refine structure-based invalidation. You never learn tolerance. You never allow data to mature. You stay stuck. Now let's talk about institutions. Institutions do not trail stops to entry quickly. They scale out based on objectives. They hedge exposure. They manage inventory. They understand that time and trade matters. Retail traders want instant validation. Institutions want completion of narrative. That difference is everything. Break-even traders exit narratives halfway and wonder why nothing works. And here is the most aggressive truth of this chapter. If break-even was profitable, funds would use it. They don't. Not because they are reckless, because they understand probability. Funds accept losses cleanly. They allow winners to breathe. They do not flinch at retracement unless structure is violated. Retail traders flinch constantly. This chapter forces one conclusion, whether you like it or not. Break even is not conservative. It is destructive. It trades long-term profitability for short-term emotional comfort, and comfort is expensive in this business. By now, it should be obvious that break even is not a technical rule. It is an emotional dependency. Traders do not cling to break even because it works. They cling to it because it makes them feel safe. And safety is addictive in an environment that constantly threatens your self-image. This is where the real trap is revealed. Most traders are not afraid of losing money. They are afraid of being wrong. Break even offers a way out. It allows you to escape accountability. You can say, the trade didn't lose, instead of saying, my idea was invalidated. That distinction matters psychologically. Not losing feels like winning when confidence is fragile. So traders protect that feeling at all costs. They move stops too early. They cut exposure too fast. They interfere with trades that are still structurally valid. And then they call it discipline. It is not discipline. It is avoidance. Avoidance of emotional discomfort. Here is what actually happens neurologically. When you move a stop to break even, your brain receives immediate relief. Relief releases dopamine. Dopamine reinforces behavior. Over time, you are no longer trading for profitability. You are trading for relief cycles. Enter trade, feel uncertainty, move to break even, feel safe. That loop becomes the objective. This is why traders say, I just want to protect my capital. But what they really mean is, I want to stop feeling uncomfortable. Markets are not designed to accommodate comfort. They are designed to extract value from imbalance. If you cannot tolerate discomfort, you will never stay in imbalance long enough to be paid. Now let's talk about confidence erosion, because break even slowly destroys it. Every time you get stopped at entry and price runs, a small fracture forms. You were right, but you were not rewarded. Over time, those fractures accumulate. You start hesitating on entries. You start doubting setups. You start second guessing execution. Your model did not fail you. Your management did, but the mind does not make that distinction. It just remembers pain. So what do traders do? They compensate. They re-enter late. They chase. They widen stops emotionally. They increase size to make it count. Break even leads directly to revenge behavior, even if the account never shows a loss. That is the silent damage. Now, here is the paradox that traps most traders permanently. Break even makes you feel disciplined while training you to break discipline. You override your original plan. You interfere without structural reason. You justify it because the outcome was neutral. That trains inconsistency. Once inconsistency is normalized, rules stop mattering. And when rules stop mattering, everything becomes discretionary chaos. Now let's talk about identity. Many traders build their identity around being risk averse. They pride themselves on not blowing accounts, on being cautious, on surviving. But survival without growth is stagnation. The market does not reward survival alone. It rewards productive exposure. Break-even traders survive years without progressing. They are always close, always almost there, always one tweak away. That is the longest prison in trading. Now, understand this clearly. Institutions do not fear losses. They fear inefficiency. Retail traders fear losses and tolerate inefficiency. That is why capital moves in one direction. Now, let's expose the final psychological layer. Break even is a response to distrust. You do not trust the market. You do not trust your model. You do not trust yourself. So you take control where you can. You move the stop. You feel empowered, but that control is fake. True control comes from accepting uncertainty and executing anyway. This is where professionals separate themselves. They are not numb. They are regulated. They accept that some trades will hurt. They accept that drawdowns are necessary. They accept that patience is paid in discomfort before profit. Break even avoids that payment. And anything that avoids payment avoids reward. This chapter exposes one unavoidable truth. If you are addicted to break even, you are addicted to not feeling pain. And trading requires pain tolerance, not recklessness, not gambling, but tolerance to sit in trades without interference, tolerance to let probability unfold, tolerance to be wrong cleanly. Without that, you will always sabotage success at the moment it begins. If break even is the trap, then structure is the escape, but not the fake structure retail traders use. Not rules designed to soothe fear, real structure, the kind that survives volatility, manipulation, drawdowns, and time. Professional trade management is not about avoiding loss. It is about allowing probability to complete its work. That is the first correction that must be burned into your thinking. Institutions do not ask, how can I make sure I don't lose? They ask, what invalidates this idea? That question changes everything. A professional stop is not emotional. It is contextual. It is placed at a level where the narrative is wrong, where the premise collapses, where liquidity has already done its job and continuation is no longer logical. Once that stop is placed, it is respected, not adjusted out of fear, not pulled closer for comfort, not micromanaged, because micromanagement is distrust. Now understand this clearly. If your stop placement cannot survive normal retracement, then your analysis is incomplete. The solution is not break even. The solution is better structure, better entry locations, better understanding of draw on liquidity, better patience. Break even is what traders use when they do not understand why price moves the way it does. Professionals do. Now let's talk about when management actually happens. Retail traders manage trades too early. Professionals manage trades after objectives are engaged. There is a massive difference. Early movement means nothing. Displacement toward a higher time frame objective means everything. Until price reaches a meaningful level, the trade is still in development. Interfering before that point is sabotage. Once objectives are engaged, decisions are made based on logic, not fear. Scale partials at meaningful liquidity, reduce exposure where reactions are expected, hold runners where expansion is still probable. This is intentional reduction, not emotional retreat. Now let's address trailing stops, because this is where many traders replace break even with another trap. Trailing stops are not bad. Blind trailing must respect structure. It must trail behind protected highs or lows, not behind your feelings. If structure has not shifted, your stop should not move. Professionals do not trail to protect profit. They trail to respect market evolution. There is a difference. Now, here's the part most traders resist because it demands maturity. You must accept full losses cleanly, no negotiation, no justification, no internal debate. A full loss taken according to plan is a successful trade. Why? Because it preserves expectancy. It preserves discipline. It preserves clarity. Break even avoids pain now and creates confusion later. Clean losses hurt briefly and strengthen the system. That is the trade-off professionals accept. Now let's talk about holding winners, because this is where real money is made. Most traders have never held a true winner. They think they have, but they haven't. They take partials too early. They reduce size too fast. They exit at the first sign of retracement. Why? Because they do not trust expansion. Expansion only rewards those who can sit through uncertainty. Institutions sit, retail traders flinch. The market does not pay flinching hands. Now understand this final truth, because it ties everything together. Break even exists because traders want certainty. Profit exists because markets reward uncertainty tolerance. You cannot have both. The moment you demand certainty, you cap your upside. The moment you accept uncertainty, you give probability room to work. That is the line between amateur and professional. Professional trade management is boring. It is repetitive. It is uncomfortable at times, but it compounds. Break even feels good. It feels safe. It feels responsible, but it keeps you stuck. And the market does not punish mistakes as harshly as it punishes stagnation. So if you remove one thing from your trading after this series, remove this: the belief that avoiding losses is the goal. The goal is productive exposure, exposure aligned with structure, exposure managed with intent, exposure allowed to breathe. Do that, and the market will finally start paying you for being right, not just for entering, but for staying.